Hello again, everyone. Welcome to another Federal Tax Update podcast. It's Roger and Annie, and we're back from Dallas and doing this solo again.
That's right. Back to work.
Yeah, it was great to see you in Dallas, and I hope if you listened to that episode, you enjoyed it. If not, go take a listen to it. It's a little different than what we normally do, but it was fun to be together. Yeah.
It was fun. It's something different. We had to lighten it up a little bit.
Yeah, you got to break it up every now and then. So, what are we going to talk about today? What's the theme of today's podcast?
The theme of today's podcast is, why is it a tough time to be trying to plan for taxes, for year end, for next year? Just kind of looking ahead. Why is the environment right now so hard to determine what steps are actually smart ones to take or ones maybe you shouldn't take? So planning for the unknown. There you go. That's kind of our theme.
And it's not all just taxes. There's a lot of unknowns and some other things, and we'll talk about them. But yeah, it's an odd year as we are completing one deadline, one more to go as we record this. Normally, we turn straight into just our normal, well, let's look ahead and let's do tax planning. But we got a lot of other stuff to consider and to plan for and to consider getting done between now and the end of the year. So, yeah, it's as good a title as I can think of.
Well, we're so used to planning, bunching expenses or shifting income from one year to the next, depending on what's more advantageous. But this year, it really is like, what is the law going to be? What's going to happen at, come next year, or the year after, or even, could we see anything retroactively change in 2024?
Yeah. We don't know.
Right.
I mean, to your point, typically when we do year-end planning, we have some consistency or predictability, maybe is a better word, in what the law is going to be. And we look, where do we put income to get the lowest rates? Where do we put deductions to get the biggest benefit? And that still may be true. That still may be the right thing to do. But there is some uncertainties out there that start with the fact that, and I'm sure this won't be a shock to anybody, because if you turn on your TV or radio, you know it, there's an election going on. And we've heard, that I can remember off the top of my head, tax proposals from $25,000 credit to buy a house, to
I heard that.
no tax on tips,
Yep,
to no tax on Social Security, to no tax on overtime, to increase child tax credit. All of these things, which I notice are all beneficial to voters, nobody's. Right. Now, they do talk about raising some taxes, and all of that's in the context of an election and the expiration of the Tax Cuts and Jobs Act at the end of 2025.
Correct.
And these are things I just mentioned have nothing to do with the Tax Cuts and Jobs Act. So these are on top of that. So the uncertainty going into 2025 is, are we going to get any of these things, or is this all just election talk?
Yep. And not just the presidency, the House and the Senate,
Hugely important, because if one party were to run the table, taking over the White House, the House, and the Senate, depending on which that party is, there's no guarantee the Tax Cuts and Jobs Act could make it to the end of 2025. The Democrats are really much opposed to it. They didn't support it when it passed back in 2017. So if they were to run the table, are they going to allow it to run all the way through 2025? Because they've got the power to stop it immediately, to make changes mid-year or first quarter or whenever they could all get together on something. So the results of the election could impact the short-term status of the Tax Cuts and Jobs Act.
Well, and I imagine that whoever the president is, they're going to want to come out with a bang, get something out there, get something known for their term. So I don't think there's going to be a lot of just waiting around. I think it's going to be on fire. I think we're going to be going as soon as the election's over.
Unless we get a divided government where one party has one of the two and the other party has the other two, then it gets hard to get anything done. So, and the one thing we have to remember when it comes to the Tax Cuts and Jobs Act is, doing nothing, it goes away on its own.
That's right. It will expire 12/31/25 and revert back to where we were in 2017, which if I had to name describe what the tax return even looked like in 2017, it would take me a minute. I'd have to go back and look and see, because it's been some time now.
Yeah. Yeah. It's been a while since certain things that now we just assume are the law. And Annie, I'm going to ask you to go through some of these.
Oh, sure.
We have to go back and start remembering what goes away and what comes back. Because if you remember when the Tax Cuts and Jobs Act was first instituted, some people were happy about it and some people weren't. Like if you live in New York or California, you weren't really thrilled about the cap on state and local taxes at
That's right.
$10,000, because that wouldn't cover a small house in either of those two states. So you'd be happy to see that go.
Right.
But then you got to consider whatever else would go or come back with it. So let's go back in time here.
Sure.
Let's do a little reminiscing and remind people, if nothing happens, what does our tax law look like at the end of 25?
Sure. So the Tax Cuts and Jobs Act did lower the individual tax rates, kind of shifted the tax brackets a bit, so if you would say, maybe restructured them. It did double the standard deduction, but remember, we used to have that personal exemption.
Took that away.
It took that away, but doubled the standard deduction. Lots of impacts on Schedule A, like itemized deductions. Roger mentioned the SALT, but there's some 2% miscellaneous deductions that just went off the table. We'll go through some of those. The increased child tax credit, that's very big on both sides. We've heard that, different amounts proposed by both parties. The reduced AMT burden on taxpayers, so there were fewer individual taxpayers subject to AMT through the Tax Cuts and Jobs Act. And if you recall, that's when the QBI deduction, the Section 199A deduction, came into play. So that does affect some business owners. There were some more favorable depreciation limits for qualified property, so you could you could take depreciation faster, more upfront than spreading it out over the life of the asset. So that's just a few. There's no way we're going to get through all of them, but
And not all of them would go away. There are some parts of the Tax Cuts and Jobs Act. Well, I don't know if they're part of it, but there's a belief that there's some universal approval, like increasing the child tax credit seems to be popular on both sides of the aisle. So no
it's
matter
just the dollar amount.
how much, Harris has proposed a different credit in the first year a child is born of $6,000, then an increased child tax credit after that. You haven't heard that from Trump and the Republicans. You've heard for an increased child tax credit. The 199A is definitely the qualified business deduction. That's definitely falling on party lines. Republicans say businesses can't do without it. Democrats say it's a gift to the rich or whatever. So there's huge disagreement in that area. There's some common ground on R&D credits.
That is another big one.
So I think you can look and say that child tax credit, R&D credits are going to probably fit in no matter who takes control. We'll see something there. What was interesting, and I don't know if you saw it today, we subscribe to Checkpoint Edge. It's a Thomson Reuters research product, and our offices have it as well. There was an interesting article today about some discussion in the Senate Finance Committee between Republicans and Democrats about fairness in the tax system and how
I saw that.
So politics get into this, and we've even heard things like taxing unrealized gains for high income people, and there's a whole discussion of whether that's even constitutional, because our Constitution addresses an income tax.
That's right.
A wealth tax, if that's what you call it, may or may not be constitutional, and God knows the record keeping that would require.
Yeah.
And then you get into, okay, we hear 400,000 is some sort of line to say, well, we're not going to hurt anybody over 400, but we have differences even between Biden and Harris over capital gains rates.
I saw that too.
Biden wanted to go to some level and Harris has a different one. So there's just huge amounts of uncertainty that our political system is going to kind of dictate which direction we go.
Yeah.
And depending on, and I'm not making a political stance here. I'm trying to be as neutral and listen to these things. Some of the stuff I hear, it's like, come on, how are you going to do all this tax-free on this and tax-free on that and tax-free on this? Because at some point, we're going to go broke as a country if we don't collect enough tax.
Right. Yeah.
But, if it gets a vote, they'll get a promise. So I don't know that you can believe all of that. I'm old enough to remember when Social Security benefits weren't taxed. The Clinton administration started that. So, but I also heard, and I didn't know this, that the money collected from that tax goes into keep Social Security solvent. I don't know if that's true or not. It seems like money in Washington is fungible. They can collect it from anywhere and say it went anywhere.
Right.
But so it's going to be an interesting year, and the election's going to have a lot to do with it. And you're right. It's not just the White House; it's the Senate and the House.
Yeah, and like I said, it's unpredictable at this moment. So making an assumption, how could you possibly plan? I guess what I would say, if you were trying to plan, I would just get your facts straight that if nothing happens, this is kind of where we go. And then just, follow along in the news. We know child tax credits up there, R&Ds up there, the SALT deductions up there, capital gains rates, like you said, are up there. And I feel like those are like the big rocks that could help with planning, but to know exactly what's going to happen is impossible.
Yeah, and I think we have to have good, honest discussions with our clients that, we can only plan based on what we know. So we know what we think we know about the tax code for next year, but things can change. I would put, just because it takes a while for anything to happen in Washington, my gut tells me we'll have most of the Tax Cuts and Jobs Act for 2025, unless one party just rolls in the election.
I
can
see that.
If you don't have 60 votes in the Senate, it's going to be hard to force anything. But if either party were to get 60 votes in the Senate, the White House and the House, they can do anything they want to, and they might. So I think it's safe to say we have to plan for the law that is on the books for 2025. But I think it would be negligent not to talk to your clients that as they make decisions, if they make big income decisions based on that they have to at least consider the fact that things could change. And what looks like a great decision today could turn out to have been the wrong decision if events that we couldn't predict or didn't know were going to happen actually happen.
Right. Well, there's some, like we can talk about like the rates, for example, the individual tax rates. If nothing happens, then right now our lowest rate is 10% and our highest rate is 37%. And there's different brackets in between.
Right.
But if the Tax Cuts and Jobs Act sunsets, then the top rate would go back up to 39.6. Right. So, those kinds of things, the standard deduction, remember, it had doubled. So we're going back to half. Would they bring back the personal exemption? And what dollar amount would that be? Because we're talking numbers from 2017. So if you look at, inflation adjustments, what does that actually mean in tomorrow's dollar?
Yeah. And how do you tell somebody how to plan for a moving expense that's currently not deductible for most people and could be, or employee business expenses? I remember when the top Tax Cuts and Jobs Act first passed, all these people who were claiming business expenses as an itemized deduction kept wanting to claim them, and it took about 3 or 4 years before they realized they couldn't.
They're going nowhere.
They're going nowhere. They may come back. Who knows?
Yeah.
Because once you get to that level of changing the tax code, all bets are off.
Well, yeah. And I really think the mortgage interest deduction would change and the SALT deduction would change. And I think both of those have strong opponents and proponents on both sides of that. So
I don't think people realize the mortgage interest deduction did change with the Tax Cuts and Jobs Act in terms of the maximum amount plus how we treat home equities, and
equity
those
loans,
sorts of things versus what they were before. So it's going to be an interesting. 25 is going to be, well, first of all, November is going to be an interesting election.
I was about to say, don't go that far, because I think between now and November is still pretty exciting.
Yeah, I just want it over with. I'm tired of the commercials.
Just watch football.
Yeah. Well, now they're butting into football. Every commercial on a football game
that's
is
true.
political. So I'm ready for it to be over. I think we'll have a little better idea of where taxes are going after the election, but who knows? So this is an interesting year. Now, there is one thing, Annie, that is new this year. Well, I don't know let me make sure I'm getting my dates right. It's going to be new for most of us things we're going to have to deal with. We got a lot of energy credits that came through what was called the Inflation Reduction Act, and
Yep.
not sure what energy credits have to do with inflation, but there you go. But one that we're all going to have to be dealing with, it may not be obvious, and talk a little bit about it, if you will, this people who bought electric vehicles.
Yes. And it is a super hot topic. But what's even more important is that when this year comes to a close and you're getting ready to prepare taxes, you're going to need that time of sale report. So remember, the seller of an electric vehicle has to go onto a website, enter information. They can calculate the amount of credit based on different criteria. And then there's something that says at the time of sale, this is the credit. Now, the buyer of the vehicle has two options. The buyer can either take the credit on their income tax return and pay full price for the car, or they can reduce the price of the car right then and there and actually pay less for the car, but then you can't double dip and also get the credit. And so you got to have this sheet of paper, and the calculation of the credit at the time of sale is dependent upon your adjusted gross income. So you're estimating an adjusted gross income. So that could also have changed significantly from when you calculated the credits, when you go to file your taxes, and when you take delivery of the car, and all these little things that are new. There's even a new form. It's Form 8936. So that's something that you're going to have to ask your clients about. They're going to have to get a copy of that. If they lost it, there's a way to go get it and have those discussions. I think the vehicle, the max amount is $7,500 for the clean vehicle credit, and then there's depending on the minerals or something that are used, you can get $3,750. So battery components or requirements or something along those lines.
New and used. I think, the calculation, because there's different, you can use different years at AGI based
That's
on
true.
which
Yes.
year it comes lower. I think the calculation, we're all used to doing calculations. I think the thing that we're going to have to remember is to ask our clients if they bought an electric vehicle and took a credit at the dealer, because they may think, the taxpayer may think, well, I handled it all at the dealer. I don't need to tell my tax preparer I bought an electric vehicle. But we have to do some form of reconciliation, if you will,
Correct.
to what the dealer did. And anytime you bring in a third party like a car dealer in, some are going to be very good at it and do it all the right way and give them all the documents and give them all the warnings, and others are going to not. So we have to make sure we get engaged with our taxpayers to make sure that what they may think is a non-reportable event on their tax return because they dealt with it at the time of the purchase, we still need information, because I'm guessing if there's nothing on the tax return, the IRS is going to send a bill for whatever the dealer said we gave them.
Yeah, absolutely. I don't know how they'll do the reconciliation, but I do know that they need the bill of sale as proof, and that there's a way, if a buyer lost it, misplaced it, never got it, whatever it is, that there's a place that you can go to get a copy. So that's going to be like some training of your clients, and I'm sure there'll be mismatches, and there's always going to be something when you are doing a new calculation like that. And I keep saying clean vehicle credit, but that's also hybrids. So the plug-in hybrids also count. So I definitely recommend making sure you have something on your tax organizer to identify, did you purchase a clean vehicle, maybe a couple of examples of what those are, and that way it doesn't get overlooked.
Yeah. And unfortunately, we all know that everybody fills out their organizer completely and correctly. So even if it's there, I'm assuming most of the tax software companies are going to have some basic questions
or diagnostic or FYI, something.
Yeah.
I agree.
We need to make sure we push the client, because, again, it's not something they've ever had to deal with before. It's going to appear to them when they handle it at the sale that I did it. I've already taken care of. So just going to be an aggravation maybe at the during tax season, just one more thing to deal with. But, there you go.
And to be honest, I haven't heard much talk between the candidates about increasing this or removing this, or have you heard much talk about anything related to the clean vehicles?
No, I don't guess there's not a constituency for clean vehicles because, they want to give away tax on tips
I
when they're
saw
talking
that.
to the waiters and waitresses, and they want to give out Social Security when they're talking to old people.
Mhm.
They want to give it houses when they're talking to young people that
Young
can't
people
buy a
buy
home.
in.
So I don't know where the constituents for electric vehicles are, but if they ever show up in front of one of them, I'm sure they'll tell them they're going to increase this too and make it easier. And
Yeah.
it's,
Yeah.
and again, how much of that's just politics and what will actually happen? But we have to be aware because your clients are going to hear it. I guarantee you, somebody's going to come in and say, I don't have to pay tax on my overtime because I heard, I think it was Trump that said it. So you're going to have to say, well, first of all, that's in the future. It's not law yet. And just because it's said in the campaign doesn't make it so. And the most interesting, this is the one comment I'll make, and I don't even think it's political. I think it's factual. The interesting thing, since both parties have said taxes on tips should go away, I can't wait to see what the true amount of tips people actually earn is, because now they'll be able to turn them all in for the first time in their life.
For the first time.
Yeah, so it may be a trick to get everybody to admit how much they earn, and then they'll go back and start taxing it again in a year or two after they've admitted what they got.
Hey, I don't put anything beyond us. I think anything can happen at this point, but I have heard that, and I'm sure there'll be other hot topics that come up in the next couple of weeks that maybe you're like, oh, we didn't think about that.
And it's always the devil in the details. I'm not going to tax your tips, but I'm going to tax your wages at 3 times the regular rate or something. I mean, that's the thing about tax reform. It's at the end of the day, somebody says, we get asked a lot because we're in the small business community to offer comments on 199A. They want us to say, well, it's saved the world, that without that, and what would it mean if they repealed it? And my answer is always, well, what do they get in exchange?
Yeah.
I mean, I don't know.
Got to give something up to get something.
Now, if you don't give them anything and you just repeal it, yes, that will be a huge tax increase on most small businesses. But if you're going to take that away and cut their tax rate in half, I don't know how they'll feel about it. Yeah. So until I can see the entire picture, I don't have an opinion on one piece of the tax law until I see because it's a trade-off. We're trading this for that, and until we see the whole package, each individual piece gets a lot of attention. But at the end of the day, a small business owner cares more about the end result than how they got there.
Yeah, and we're talking a lot about individual tax provisions and small business, things that affect small business owners. But there was a lot in the Tax Cuts and Jobs Act. There was stuff related to estates and gift. There was stuff about retirement plans. So I mean, it is a huge piece of legislation, and we're barely just hitting the surface. So keep that in mind.
And there'll be different winners and losers, just as there were when the law was passed. If it were to go away, there'll be different winners and losers, but it won't typically be because of one. I mean, there's situations where one piece of the law could have a hugely adverse effect on someone. But generally speaking, you got to factor it all in. That was the thing that I found interesting when they gave up itemized deductions for moving and expenses. If their tax rates went down enough, they didn't care because they paid less. Now, what they really wanted was the tax rates to go down and the deduction, but at the end of the day, their taxes may have gone down. And they didn't care. If their taxes went up, they care. That's been when somebody says, how does people feel about, complexity in taxes? I said, no one complains about complexity if their taxes go down.
It's all about the bottom line.
It's the bottom line. And this is going to be no different.
Well, and in all honesty, the IRS could take a hit on this too. Because I mean, they're funding. I guess the IRS tax professionals. There's enough going on right now that it could affect how much funding the IRS retains or gets in the future.
Oh, there's no question about it. Because remember, and again, it was the Inflation Reduction Act gave the IRS unprecedented increases in funding, and we'll talk a little bit about what they've done with some of that money.
Yeah.
But the Republicans opposed it. The Democrats supported it. Democrats had the vote, so the money's there.
Some of it got clawed back even already.
They have clawed some of it back in negotiations, but there's still a big pot of money there that's allowed the IRS to do some things that we'll talk about that I think have been positive. that at least from the IRS perspective wouldn't have been possible without that money. Now, you can argue whether they could have taken it from, but their message is this is only possible because of the funding. But that's a political. Remember when this came out? 84,000 armed agents.
Yeah, I remember all the pictures, social media of all these armed, with rifles, all the IRS agents carrying guns, knocking on doors. I remember thinking, that is not what's happening.
Anyway, while we were in Dallas, we had the pleasure of spending an hour with the IRS Commissioner, Commissioner Werfel.
Yeah.
And a good part of that, he talked about some of these things we're talking about in terms of how this money has helped the IRS, what they've done with it, what they're doing with it. Talk a little bit about what he said and your impressions of the commissioner and how you felt about that meeting.
Yeah, I mean, so that obviously was the first time I had personally met him. I know you get to visit with him often, but it was very exciting, unique situation, sitting around a big square table, some professionals in there, and he's sort of just of course, all of his bodyguards are all around too, security detail. But, he's sitting there and you could just, he was so intense. He was listening to everybody, looking everyone straight in the eye, really trying to understand what they were saying. And he went, around the room and he focused, he took notes. He was trying to really be a listener. He wasn't lecturing, he was listening, and you could see that he actually cared. And I think after probably 45 minutes, 50 minutes in, we had come down to like three main, at least, topics in the room. And that was about the IRS funding and their technology and their hiring and how are they hiring and how long does it train people and how they shift people from, this phone line or this service line during tax season, but then kind of reallocate their resources post-tax season. And what does that look like? And is that good? What are the benefits? And, what are some of the cons, I guess, of having, being in a spot where you're basically having enough people retire as you are hiring. And so you're not, even though you've got the money to hire, you're losing the qualified candidates as well. So that was interesting just to hear how the numbers work, I guess, behind the scenes, as far as, how many people you have answering the phones or how many people are, sending out notices or doing audits or what. The other really big thing, and this will not be a shock to anyone, is the tax scams are off the charts. We talk about ERC all the time, but it's beyond that. It's, I guess, in his words, the fraudsters are smarter and can build the infrastructure fastest. And we can't keep up. We're unable, we implement changes and we implement safeguards, but these fraudsters are way ahead. So that's something that they are trying to get a handle on. An example of that is obviously the ERC mills. And then also tax professionals, we're struggling too. It's hard to hire. We're not necessarily billing for our value. So there's not as many people coming into the tax profession. I saw today, who was it? Somebody proposed getting rid of a plan to get rid of the 150 hours for CPAs.
Oh, yeah. And another one of the big firms laid off 100 and something thousand.
I saw that too.
Yeah.
So we're seeing, the professions hurting, but there are clients out there to get. People are always looking. So we're kind of struggling with a balance, I guess I could say. I don't know. I really enjoyed the lunch with him. I really enjoyed listening to what other tax professionals had to say. I don't know. Hopefully I'll get to do it again.
Yeah, and it was interesting, too, because he had some of his executive team in the room with him, and at times he would hear something from a tax professional and would then look at them and said, what are we doing about this? Here's what we should do, or go, so it was immediate. But yeah, it was interesting to hear, how they shift people, which again doesn't surprise me if you know that they shift people during the filing season. And the fact that they're hiring, I think he said that they're somewhere in the 95,000 currently, and their goal is to get over 100. And
well, they were hiring on the spot at these IRS forms. Right there, offering people a job. So I definitely would agree that they are aggressively hiring. They are out there trying to get good people to come work for them.
Now, and the sad and frustrating thing, and we've all dealt with it, is that when you lose someone with 20 years of experience and replace it with somebody with 2 months of experience,
Yeah.
it's a completely different environment to work with them. And you can't fix that overnight, but at least they're able to bring people in now and put people in the chair. They're not going to have the same experience. So I think as we've all seen before, when we see new people, we're sometimes going to have to help train them because
Yeah.
they're going to learn from the textbook, and we're going to teach them what the real world's like.
And he did mention, there's going to be a learning curve, and so sometimes you could call the IRS and you're going to get somebody on the phone that's efficient and quick and solves problems, and then you're going to get somebody who's more new, has to go talk to a manager, maybe doesn't come up with the answer as quickly, but there's tax practitioners can also use the practitioner priority line, so don't forget about that if you're having trouble getting through. Although there were lots of improvements with the technology, turnaround time. We had mixed feelings about the callback feature. But sometimes it was working very well, and sometimes you didn't get a callback. So I don't know.
Annie, you mentioned ERC. That came up, as it always does, with a meeting with the commissioner. Talk about some of this stuff. There's some new stuff that maybe, I don't know if it's new to some of you on this call. It's relatively new. Let's remind people, at least what the new stuff is, and we can talk a little bit about what the IRS's opinions and thoughts are as it relates to this going forward.
So if you have heard any of our podcasts, we always talk about the employee retention credit. It's something that I wish would go away, but it is still around. And sort of where we sit today is, one, there's a voluntary disclosure program. So this is for those who it's only for ERC claims for 2021. The 2020 period is closed. So
this is another voluntary program. This is the second.
It came back. Remember, or got modified, I guess I should say.
Yeah.
But basically, you get a reduction in penalties by voluntarily disclosing improper claims. So if you had best intentions or went to a mill and you thought you qualified and you got your money, but you're now like, I was wrong, I didn't qualify, you can voluntarily disclose it, and you will eliminate the penalties and interest associated. Now, the reason we're talking about it so much is that the timing on this program will end November 22nd of this year. Mm-hmm. So you have an amount of time to pay, to correct the claim and pay back the amount of the credit that you got at a 15% discount. It was 20, but now it's 15. So you still, if you pay it back, you don't have to pay it all back. There are payment plans for it. Again, it's the 2021 period. You don't have to go back and amend the tax return. So that's another, so if you have a client that got the money or claimed the credit and shouldn't have, and now they want to make it right, this program is available through November 22nd of this year. So,
and this is the second time. The first one you could pay back 80%. This one's 85%. They didn't come in, and I don't think they would if we asked. Will there be another one after this? So this may be your last chance to get the money paid back.
Yeah. Given that the 2020 period is closed and we're just looking at the 2021 claims, which was more money than the 2020 period. But I don't anticipate another one, but I've been wrong before, so you never know.
And he also talked about they are processing some claims. Again, I think we've talked about this, I'm pretty sure we have on podcast, and they're kind of putting them in three buckets. One bucket where they're doing it. They took the moratorium time, and let's make sure people understand this. They weren't just sitting around doing nothing. They were trying to decide how to better process the claims to determine the legitimate ones before the money goes out versus the ones that might be fraudulent. And they came up with a lot of analytics and a lot of studies. And so now some claims are being paid in full, no questions.
Right.
Some are being rejected. There's just obvious, like you said, you're entitled to $100,000 and you didn't have wages of $20,000 for the whole quarter. And we can see that. We can see that on your 941. So some are just obviously being rejected. And then there's some in the middle where they're asking for additional information. But all of that takes a long time. So the sad part about it is the people who filed legitimate claims and needed the money in the pandemic, they may get it, but will they still
Might be
be
too late.
around? Yeah.
I know.
Will they still be around? So it's still out there. ERC's still out there. Like, I think everybody feels like you, Annie. If we could just go away, we'd all be better. And
Yeah.
we're still barred from preparing an amended return if we don't know that the claim that they got was accurate. So I know we brought that up with the commissioner. That seems a little stupid to say it can be 100% wrong, but you won't take back 30% of it on an amended return. You'd rather keep it 100% wrong and me refuse to amend the return, which puts me in a bind because then they're going to go somewhere else.
Somebody down the street will do it.
Or they'll just never do it. And now you've
that
you've got a worse collection problem and enforcement problem, and you're chasing 100% of the money instead of 70% of the money. Yeah. So I don't know if we'll see any changes on that, but it's this ERC, it's not going anywhere anytime soon. And even if you didn't ever file a claim for a small business, you may have a taxpayer come to you this tax season that you're going to have to deal with. ERC.
Got to ask the question. Did you get it? Did you get the money?
Yeah.
What year? What period? Did you amend your returns? So it's going to be a lot. But I did like the visual that he gave us when we were sitting in that room. He was sort of like, if you had a timeline of claims, you kind of chopped off the ones that were a go and sent the money, and you kind of chopped off the ones that were blatantly wrong. And so you're left with, these
that group in the middle.
Claims that are going to take longer to process, but that they will continue to go through them. They may ask for backup information, maybe make changes to the calculations. I don't know, but at least we see a little bit of progress. And I feel, and they don't even have the bandwidth, their staff to go through this. So we talked about resources and reallocating and triaging employees, but in order to get through these claims, they have to pull people from somewhere else. So It's sort of a tough place to be in. I would not want that job, I can tell you.
Yeah, this is a signal of where we all, on one hand, we want the IRS to process these claims because all our clients are legitimate and they need the money. At the same time, we want them to answer the phone. We want them to respond to notices quickly. We want them to do all these other things. And yet, when you're understaffed and underfunded, you're moving people around, and something like the ERC is becoming because there's massive amounts of money being handed out in this program. And so you're having to allocate a lot of resources to it. That makes our life a little more difficult in dealing with the IRS in our more traditional ways, right? Because a lot of the people that we would be working with are now over here trying to help either get the money out or keep the money in if it's not legitimate. So let's see. So we're in the fall. We got potential changing tax law. We got ERC still hanging over our heads.
Presidential election.
Another deadline.
Yes.
And we have beneficial ownership. That has to be done by the end of the year as of today. So Annie, let's go back through.
Sure. For
people that aren't familiar with it or any updates that we might have on it, let's talk a little bit about because beneficial ownership is something while you're planning for taxes, planning for ERC, has to be done by the end of the year.
Yes, you can't wait until busy season to address this one. You have to get in front of it and get in front of it quickly if you haven't done so. So it's beneficial owner information reporting. You may have heard the term BOI. I guess if there's anything you're going to take away on this topic today is be ready to talk to your clients, especially as we get closer to year end. So this is the Corporate Transparency Act. It's not IRS. It's with FinCEN, which is the Financial Crimes Enforcement Network. Not an IRS initiative, but it has become a huge burden on tax professionals who want to assist their clients in preparing this form. But because it could be seen as the practice of law, generally CPAs, generally tax practitioners, cannot do that type of work. So it wouldn't be covered by E&O insurance. And this is the scariest part. This is the scariest part of it all. This new reporting requirement. As of December 31st, you have to file your initial report, or you could be subject to a penalty of $10,000 fine and up to 2 years in prison. Now, that's for willfully providing false information, but a clear definition of what that actually means has not been provided. So you're looking at, small business clients who may or may not have even heard about this, having to do something not with the IRS, but something with FinCEN, not on April 15th, not an annual thing, but for an initial report, December 31st of this year. And it's something that is, to me, is so difficult because there's so many small business owners who are completely unaware. They're
They have
not,
no idea.
they have no idea. And, FinCEN says they're not going to go after, the good guys. We're just trying to get the bad ones. But what does that really mean? And I don't know. I don't think I'd hang my hat on that if it was me.
Well, they won't tell you what it is, so you have to
Yeah.
assume the worst. And
Yeah.
the sad thing about this is for businesses, and this again applies to any business that's set up with your Secretary of State. So
Yep.
your sole proprietors, unless they're exempt over here. It can't wait till you see them during tax season. So for your
Right.
small business S corp that comes to you in February with their tax information, that's too late. It had to be done by December. So you've got to figure out how to communicate with your clients before the end of the year
Mhm.
and have time to give them the information that they need so they can give you the information that you need so you can file the report by December 31st. So you've got to start thinking about it today.
Yeah.
You can't wait until you see these businesses during tax season. You've got to understand what is beneficial owners. Some of it's black and white. You own 25%. You're a certain officer. But if you have certain types of influence on certain activities, that requires you to be on this form. So it's something that if we could wait and do it during tax season, we could almost make it part of our filing routine.
Yeah. And there's been a lot of pushback, AICPA, NASBA, IRS. I mean, I know you're going back to DC this week to go talk about it.
Right.
There's a lot of pushback, a lot of requests for extensions, a lot of, why does the penalty have to be so high? What, those kinds of things. But as of right now, we haven't seen FinCEN kind of come out with, an extension period or change of who's required or who can be exempt and that kind of thing. So right now it stands and it's coming up fast.
Yeah, because FinCEN, at least as of today, and you mentioned I'll be in D.C. going up on the Hill,
Mhm.
and that'll make sense in a minute, has shown no interest in delaying it or clarifying some of our questions. They believe that they're going around, and I get probably once a week an update from FinCEN. See, we went to Kansas and we told this group about it.
Yeah,
Then we went
yeah.
over here. There's also pending lawsuits floating around out
Yep.
there. So FinCEN seems pretty dug in that we're going to keep this on the current timeline, meaning by December 31st, every business that was set up by the Secretary of State prior to the start of this year must file a report. Now, remember, if you started a business this year, they had 90 days. So when that taxpayer shows up in your office in February with their corporate return that was formed in 2024 and you ask them, can I see your BOI? They're going to go, what are you talking about?
Mhm.
They're already late because they only
Yep.
had 90 days. They would be late anyhow because you're in February. We don't have any guidance as to what we're supposed to do and what happens when we file it late. So, but Congress is at least beginning to hear some of the problems or some of the perceived problems, and there is talk of a delay. I mean, there's talk of repeal. I don't know that that's possible. Because,
I don't know. I mean, the lawsuits have not shown to be making progress.
yeah.
To a repeal. Could it happen? I guess so. And I will say, you mentioned the Secretary of State's. FinCEN seems to be working with several of the
Mhm.
states where they would share information back and forth. So you would maybe get a notice a taxpayer, when they created a new entity with the state, get like sort of a reminder or notice that you have to file this in a certain period of time. Just another way of sort of letting the small business owners know that, but they're not working with all 50 states yet. They're not cross-checking data at this point.
And some states will send out, they'll go through their database of everybody that was set up in their database, and they'll send them a notice, as a general information. So if you get a small business client of yours calling you and say, hey, I got something from the Secretary of State, what is it? It's probably some sort of notification about having to do this BOI report. But last we heard, less than 10% of the businesses that are estimated to have to do this have done it. So
exactly.
They can say all they want that they're doing a good job of educating, but
it doesn't
less than 10%.
appear to be.
Yeah. So again, it's just one more thing we have to deal with during this next 4 or 5 months while we're trying to figure out how to do tax planning, while we're trying to wrestle with but the latest version of ERC, and do our normal day-to-day work. And BOI is going to be a big one. I would make one suggestion. It's something that we did here in Paget to get prepared for this, either for yourself or for one of your better clients. Go ahead and go through the process, because you're going to hear that filing that initial form only takes 10 or 15 minutes. That may be true in a perfect world. But just accessing the right form, making a decision whether to use the online or PDF version, and
make sure you get a copy.
Make sure you keep a copy, because there's no guarantee you'll be able to find it again after you file it. To understand what information you need, where you go to fill out a form, what a client has to give you for you to be able to. We focus FinCEN focuses, well, I should say we don't, FinCEN does. Well, it only takes 10 minutes to fill out the form, but that ignores everything it took to get to be prepared to spend those 10 minutes and the risk if something is wrong. And then the real risk is going to come in future years. Whatever you put on that initial form, if something of substantial nature, and I'm not going to want to get into it today, but it's changes, including the documentation that you gave to prove that Annie Schwab is really Annie Schwab, you only have 30 days to make that correction, or the penalty kicks in again. So the first year is probably the easiest of all the years to avoid a penalty. But I would suggest, and Annie, I know it was kind of eye-opening to us to go through filling one out, just starting as if we were doing this for the first time, which we were in actual form, and finding the website, selecting the right way to do it, seeing how the form worked, and knowing how you add.
You have to upload the driver's licenses.
Go through it. So you don't want to be doing this. What my fear is, there's two fears I have. One is we're all going to be crunched in trying to do this the last 2 weeks of the year. And then the second fear is as soon as you finish, Congress is going to delay it. And so all that time that you've spent is going to be wasted, but hopefully we'll get an indication if that's possible. And I don't know how you can charge what it's really worth. I mean, that's something we're wrestling with, is how much can we charge for something that FinCEN is telling everybody only takes 10 minutes?
Yeah, but you don't want to be associated with something that gets hit with penalties and, time in jail because you didn't upload the new driver's license when it expired,
Right. No, it's just, this is going to be an end of the year, probably like we haven't seen in a while, because we got BOI, we got potential for significant tax changes. Well, I'm repeating myself because I've already said this probably 3 or 4 times on this call. But it's going to make these next 4 months, once we get through the October 15th deadline, we got Thanksgiving, we got Christmas. We're probably all going to scramble around to try to get our CPE requirements in for the end of the year.
Yeah.
You got BOI, you got potential tax changes, you got an election. It's going to be kind of an interesting end for 2024.
Yeah, I think so too.
I don't know that I'm
tired now.
Yeah. If you're tired now, you're going to be really tired come December. And,
just thinking of it all.
it's just going to be a very interesting situation that we're going to go through this year. And again, I've done this for a long time, and I don't think I've ever had anything with quite this combination of things that we're going to have to deal with. And that's why we encourage our people, and I encourage our listeners, charge what you're worth, because you're going to earn it this year.
Mm-hmm. Yep, and we'll keep doing these podcasts. And if something changes or something you need to know, check back with us because we'll bring it to you.
Yep, we will do everything we can to keep you on the cutting edge of information, whether you like it or not. We don't make the information; we just report it. So
that's right. That's right.
Final thoughts, Annie, before we wrap up today's
No,
podcast?
I hope maybe this week when you're in DC, you can have some influence on an extension for BOI or bring back some new hopeful possibilities. But
yeah, I'd like another year to sort through some of, because there's some just underlying, I think, issues with the whole system besides the deadline and lack of awareness. But it's going to fall back on 435 House members and a portion of the Senate, all who are running for re-election, to think this is important enough to act on while they're trying to keep their job. So,
jeez,
we'll see. Who knows?
Well, Roger, it's been fun as always.
Yeah. Hope we can get together again. It's good to see you in Dallas. Glad to be back doing it this way, but it's always fun to do it together. And I hope that you guys that are listening are happy about our podcast. If you are, share it with people. We're excited in Dallas to run up on people who had listened to the podcast.
Yeah.
And it was kind of nice to hear that there actually are people at the other end of this.
Yeah.
So Annie, I'm done for the day. How about you?
Me too. I'm done. Little League baseball tonight. That's what's on my agenda.
Well, I'm going to go pack and get ready to go to DC. So,
all right. Well, thanks everyone for listening.
Annie, thank you as always. Thank you for listening, and join us again soon on another Federal Updates podcast. Bye, everyone.
Bye.